What is a mutual fund? Essentially, a mutual fund is a pool of investors' money that is invested by fund managers in a specific strategy or an index. Every share that you own is a fractional ownership of the mutual fund. And essentially, what it does is it gives you access to investments that you typically would not have, as well as it gives you diversification of owning multiple different investments in the underlying fund that you typically would not have access to originally. You don't necessarily have to pick the individual stocks themselves. So a lot of people like that from a diversification basis because they don't want to have all their eggs in one basket, which is obviously, in most people's opinion, a good thing to do. How mutual funds are priced is on a net asset value basis, or what's referred to in investment terms as NAV. Essentially, what that is it's a combined average or a combined pricing of all of the investments in the fund. And so mutual funds, unlike most other securities, get priced one time per day at the end of the day. If you buy it at 10 a.m., it doesn't actually get executed until 4 p.m. Eastern time. So just be cognizant of that. There's not the ability to day trade mutual funds, and you don't always know the execution that you're going to get. So I would really pay attention to that. Now that we know what a mutual fund is, what are some of the other kind of nuances of the investment vehicle? First things first, how can you actually make money by investing in a mutual fund? There are three ways in particular that a mutual fund can help you make money. Number one is from the dividends or the interest of the actual investments in the underlying hood, underneath the underlying hood of the mutual fund. As a stock pays a dividend or a bond pays a interest payment, that then flows through to you however often the fund pays that out. Number two would be the actual growth in the net asset value, or the value of all the underlying holdings in the fund. So growth of that over time. So if you buy it at $10 and you sell it at $15, obviously the investments in the underlying vehicle of the mutual fund have grown. So that's the growth of NAV. Number three is there are these things called capital gains distributions. As the fund has ongoing strategy, they essentially will trade in and out of securities. So as they trade in and out of securities, there's going to be gains and losses on those securities. Essentially, at the end of the year, all of that's aggregated and then passed on to the shareholders. This can be quite significant in a taxable account where you actually receive a tax bill from the underlying activity of the fund managers. I would note that as mutual funds, especially mutual funds with high turnover or a lot of trades that go on underneath the strategy of the fund, can really cause a big headache at the end of the year if they've done a lot of trading. If there are these mutual funds out there, what kind of strategies are available? With the mutual fund, you've obviously got equity funds, you've got bond funds, and you've got balanced funds, along with many other strategies that are like with alternatives or commodities or different like hedge fund type of investment strategies. But probably the most important and the main ones that you guys will be looking at on the in and out, like in your account, in your 401k accounts at work, or different funds in your retirement account, other retirement accounts that you have, would be equity or fixed income or balanced, or what could also be known as a target date fund. Within the equities, there's growth funds, there's value funds, there's dividend funds. There is all sorts of different strategies or different sector exposures that you can get through these funds. So always do your own research on what you're looking for. There's lots of resources out there, and always here to answer any questions for you guys in that realm of the world. Now, what are some of the costs of investing in a mutual fund? What typically happens is there is an expense ratio on the fund. What that is a blend of what the management gets paid, and remember, they get paid regardless of if the fund does well or doesn't do well. It's a fixed rate. And then there are other like what's called 12B1 fees, which is like for distribution and marketing of the fund. and all of kind of the back office stuff that goes on within the underlying holdings and reporting and accounting. And then on top of that, in the underlying fund, they're paying transaction fees whenever they buy and sell stocks or bonds. So you don't actually ever really see these payments. It just gets deducted from your balance. So that's how those fees work. And then with mutual funds, there are these sneaky things called loads. And so essentially what that is a sales load that's in like an A-share mutual fund where they hit you with around a 5% fee in order, or commission, in order to buy that fund. What that does is it says if you buy $100,000 worth of this mutual fund today, all right, well, we're going to take 5% of it off of the front, and you're actually going to have $95,000 invested. There's a lot of different sneaky ways that mutual funds can get you. I would really keep an eye on any sort of front-end load, back-end loads, or other like ongoing loads that they can hit you with. There's also these kind of unique features like redemption fees that they can charge you for selling within a certain time after you bought it. Generally, there's a lot more nuances with different mutual funds than there are with other comparative funds like an ETF or electronically traded fund. So I would really keep an eye on some of those fees. I know that most of the time, at least in my experience, has been with mutual funds is like for my employer and my 401k, where I've utilized mutual funds. And with that strategy, it's been more like a buy and hold and don't look at it, which typically can work out well. But just be wary of the different levels of fees that are out there on mutual funds that can really, really, really wreak havoc on your long-term returns. Thanks guys for tuning into the video. Really appreciate you guys spending your time watching this video. I'm really grateful for you guys tuning in. If there's anyone that you think this video might help or might help answer questions for, we would be so appreciative if you could share it with them. Please keep an eye out for more videos to come like this. Thanks.